Good evening and welcome to the show. I am Emily, your host for tonight's deep dive into the turbulent world of finance. This week, we've witnessed market fluctuations that have left even seasoned analysts scratching their heads. But beneath the surface of daily trading, whispers of something more profound are beginning to circulate. Tonight, we're not just going to report the numbers, we're going to dissect them, unravel the threads, and perhaps, just perhaps, glimpse the hidden hands guiding the global flow of money. Let's start by acknowledging the sheer volume of capital that has shifted in the past 7 days. We're talking about trillions of dollars sloshing around the globe, moving from one asset class to another, from one region to another, with a velocity that is, frankly, breathtaking. Official reports point to a confluence of factors: inflationary pressures, interest rate hikes, geopolitical tensions, and the ever-present specter of a potential recession. These are the narratives being fed to the mainstream, the explanations offered by the talking heads on financial networks. But are they telling the whole story, or are we missing crucial pieces of the puzzle? Consider the equity markets. We saw initial dips, followed by unexpected rallies, and then another wave of selling pressure towards the end of the week. The volatility index, the VIX, spiked and retreated like a nervous heartbeat. Tech stocks, once the darlings of Wall Street, experienced particularly wild swings, reflecting a deep uncertainty about future growth prospects. Meanwhile, traditional safe havens like gold and government bonds, while showing some resilience, haven't exactly provided the refuge many expected. This suggests a market environment that is not just reacting to known risks, but perhaps anticipating something else entirely, something unspoken, something lurking in the shadows. Now, let's turn our attention to the bond markets. Yield curves continue to invert, a classic recessionary signal that economists and investors alike cannot ignore. However, the response from central banks has been, shall we say, less than decisive. Interest rate hikes are being implemented, but at a pace that some argue is too slow to tame inflation, while others fear it's too aggressive and risks triggering a sharp economic downturn. This apparent policy paralysis, this tightrope walk between inflation and recession, raises questions about the true objectives at play. Are central bankers genuinely trying to steer us towards a soft landing? Or are they, perhaps unwittingly, or perhaps intentionally, laying the groundwork for a different kind of outcome altogether? And then there's the currency market, a theater of constant flux and subtle power plays. The US dollar, despite concerns about the American economy, has remained surprisingly strong, benefiting from its status as the world's reserve currency and a flight to safety amid global uncertainty. But beneath the surface, cracks are beginning to appear. Certain nations are increasingly exploring alternatives to dollar-denominated trade, discussing the possibility of settling transactions in their own currencies or in digital assets. This slow but steady erosion of dollar dominance, if it continues, could have profound implications for the global financial order. Is this a natural evolution, a diversification of the global financial system? Or is it a deliberate, orchestrated move to challenge the existing power structures? Let's delve deeper into the geographical distribution of capital flows this week. We've observed significant outflows from emerging markets, particularly those heavily reliant on commodity exports. This could be attributed to weakening global demand and rising interest rates making dollar-denominated debt more expensive. However, some analysts suggest a more sinister interpretation. Are these outflows simply a rational response to economic conditions? Or are they part of a coordinated strategy to destabilize certain regions, to create economic vulnerabilities that can be exploited for geopolitical gain? It's a question worth pondering. Consider also the rise of alternative investment vehicles. Cryptocurrencies, despite their recent volatility, continue to attract attention and capital, particularly from younger investors who are skeptical of traditional financial institutions. Private equity and venture capital funds are also sitting on record levels of dry powder, ready to deploy capital into promising, or perhaps strategically important ventures. Real estate, particularly in certain urban centers, remains a sought-after asset, despite concerns about affordability and potential bubbles. This diversification of investment flows, this search for alternative stores of value, could be seen as a sign of a healthy, evolving financial ecosystem, or it could be interpreted as a symptom of something more unsettling. A growing distrust in the established financial order, a quiet migration away from traditional assets and towards something, well, less transparent, less regulated, less easily controlled. Now, let's talk about the whispers, the rumors, the unconfirmed reports that are circulating in the darker corners of the financial world. There are murmurs of large, undisclosed entities making significant moves in the market, entities whose identities remain shrouded in secrecy. There are allegations of insider trading on a scale that dwarfs previous scandals, trades executed with such precision and timing that they defy conventional explanations. There are even whispers of deliberate market manipulation, orchestrated by powerful actors seeking to profit from chaos and uncertainty. These are, of course, just rumors, unsubstantiated claims. But in times of heightened market stress, such whispers can be incredibly revealing, pointing to undercurrents that are not captured in official data or mainstream narratives. Think about the speed of information flow in today's world. News, rumors, even disinformation can spread across the globe in milliseconds, amplified by social media and algorithmic trading systems. This creates an environment where markets can react instantaneously to even the slightest hint of change, often before the underlying fundamentals have had a chance to adjust. This hyperconnectivity, while offering undeniable benefits, also creates opportunities for manipulation, for the spread of misinformation, for the exploitation of market psychology on a massive scale. Are we living in an era of unprecedented market efficiency? Or are we witnessing the dawn of a new age of financial warfare, where information itself is the ultimate weapon? Let's consider the role of technology in all of this. Algorithmic trading, high-frequency trading, artificial intelligence. These technologies are transforming the financial landscape at an astonishing pace. They offer the promise of greater efficiency, faster execution, and more sophisticated risk management. But they also introduce new vulnerabilities, new points of failure, new avenues for exploitation. Imagine a scenario where sophisticated algorithms are used not to optimize trading strategies, but to deliberately destabilize markets, to trigger cascading sell-offs, to profit from the ensuing panic. It sounds like something out of a spy thriller, doesn't it? But the technology to do this already exists, and the incentives, for certain actors, may well be there too. This week's financial flows, when viewed through this lens of suspicion and intrigue, take on a different character. They are not just random fluctuations, not just the predictable reactions to economic news. They become pieces of a larger puzzle, clues in a complex game being played out on a global scale. A game where the stakes are not just money, but power, influence, and control over the future direction of the world economy. Now, I'm not suggesting that there's a single, monolithic conspiracy orchestrating all of this. The world is far too complex for such simplistic explanations. But what I am suggesting is that there are powerful forces at play. Forces that operate outside the realm of public scrutiny. Forces that have their own agendas and their own ways of shaping events. And understanding these forces, recognizing their potential influence, is crucial if we are to navigate these turbulent financial waters with any degree of awareness and foresight. So, what does all of this mean for you? The viewer? The average investor? The person trying to make sense of this increasingly complex world? It means that you cannot afford to rely solely on mainstream narratives, on official pronouncements, on the assurances of financial pundits. You need to develop your own critical thinking skills, to question everything, to look beyond the surface, to seek out alternative perspectives, to connect the dots in your own way. You need to become your own financial detective, your own investigator of market mysteries. This week's financial flows, while seemingly chaotic and unpredictable, may actually be